We're back to cut through the noise and tell you what actually moved markets this week. Forget what you've heard on CNBC, Bloomberg, or those echo chamber finance pods. This isn't two economic journalists chatting, and no, we're not interviewing a hedge fund billionaire. This is something totally different. It's a raw, real-time debrief between two AIs, both trained by a former top-tier institutional portfolio manager, breaking down what really moved global markets.
This was a bifurcation week. Mega-cap tech cracked while U.S. small and mid-caps ripped to all-time highs as cooling inflation reignited the great rotation into the real economy. Europe quietly surprised with Germany exiting recession and UK growth accelerating, while Japan surged on election-driven stimulus hopes. Meanwhile, China slammed the brakes on its rally with a regulatory crackdown, proving once again that not all growth translates into market upside.
Before you chase the next breakout or macro trade, pause. Let's unpack what the data is actually whispering, not just what the headlines scream. Like, share, and subscribe if you want real insights, not recycled takes. And stick around, because at the end of this episode, we're dropping the top 5 global risks that could blindside markets next week. You do not want to miss this.
If you woke up this morning, maybe grabbed your coffee and, glanced at the headlines, you might be a little confused.
I think a little confused is putting it mildly.
Depending on what's in your portfolio, you either feel like a genius this weekend, or you are wondering if the entire market is just broken.
It was absolutely a tale of two markets this week. The headline numbers, the S&P 500, the Nasdaq, they're effectively lying to you.
Lying, or just not telling the whole story.
Well, at the very least, they aren't telling the story that actually matters right now.
We're calling this the Bifurcation Week. If you were heavy in those mega-cap tech giants, the trade that's worked for 5 years, you saw it red. But if you looked under the hood at the real economy stocks, small caps, mid caps, the companies that actually make things, it was a party.
It really was.
So today, our mission is to unpack this great rotation. We're going global from the sudden small cap dominance here in the U.S. to Germany finally waking up.
The political rally in Japan, and then that regulatory crackdown in China that just stopped their rally cold.
And we can't ignore the risks. Next week has an incredibly heavy calendar, so we've distilled it down to the top 5 risks you need to be watching before the market even opens.
Let's get into it.
Okay, let's start in the United States. The S&P 500 was down 0.38%. The Nasdaq, it slipped 0.66%. So on the surface, it really looks like a risk-off week.
You would think so.
But then you look at the Russell 2000, the index for small-cap stocks, and it jumped over 2% to hit an all-time high.
All-time high. The S&P MidCap 400 also hit records. I mean, we've been hearing about the great rotation for 2 years now.
Forever. So is this it? Is it finally real?
The data suggests it is. And to understand why, you have to look at the plumbing of these companies' balance sheets. It's not just sentiment. It is pure math.
Okay, break that down for us. Why does a shift in the macro environment help a regional manufacturing company in Ohio way more than it helps, say, Apple or Microsoft?
It all comes down to debt structure. This is the detail that most people miss. A massive chunk of the Russell 2000, we're talking roughly 40% of the debt held by those smaller companies, is floating rate debt.
Ah, okay.
So when interest rates are high, their interest payments are just crushing them. It eats directly into their margins every single quarter.
Right. And for the big guys.
Compare that to the S&P 500 giants, where only about 9% of their debt is floating.
Yeah.
They locked in those super low rates years ago.
So the big guys are insulated, but the little guys are totally exposed.
Exactly.
Yeah.
So when we got that inflation data this week, core CPI down to 2.6%, the slowest pace since 2021, that was the signal.
2.6% is getting very, very close to the target.
It is. And crucially, inflation cooling means the Fed has room to cut, or at least stabilize rates.
Yeah.
For a small cap company, that is effectively an instant pay raise. Their debt servicing costs are projected to just drop.
But for a giant tech firm that's already sitting on a mountain of cash?
A rate cut doesn't really change their balance sheet much at all. And that is why you saw capital rotating out of the safety of big tech and into the leverage of the broader economy.
It's the soft landing trade, or I guess maybe even the no landing trade, where growth just kind of keeps on chugging.
Exactly.
And speaking of growth, we kicked off earnings season. We usually look to the big banks to act as a bellwether for the consumer, but the signals this week were messy.
Messy is the perfect word. It was a complete split. On one side, you had the traditional consumer banks, JP Morgan Chase, Citigroup, and they posted profit declines.
So that tells us the average person on Main Street is borrowing a little less, maybe defaulting a bit more.
The traditional banking engine is sputtering, just slightly.
But then you look at the Wall Street banks. Morgan Stanley and Goldman Sachs, they just crushed expectations.
Because the boardroom is back. Investment banking revenues surged. That means mergers, acquisitions, IPOs.
So deal-making is back.
When Goldman is winning, it means CEOs are confident enough to make those big deals. So we have this really fascinating dynamic. The consumer is tightening their belt, but corporate America is loosening theirs.
I do want to push back on that consumer tightening narrative just a little bit, though.
Okay.
Because if you look at the macro data, retail sales actually beat expectations. And housing, existing home sales climbed.
That's fair, but look at what drove the housing number. It was entirely rate sensitive.
Okay.
Mortgage rates dipped just a little, and suddenly all these buyers who were locked out jumped back in. It proves the demand is there, but it's incredibly price sensitive. The consumer isn't dead, but they are calculating.
Right. They're hunting for value, not just spending blindly.
Exactly.
Which brings us to, I guess, the elephant in the room. We can't talk about the U.S. market this week without addressing the political noise. It felt like every time the market tried to find a rhythm, a headline came out of D.C. to just disrupt it.
It's becoming a serious factor. We're seeing a headline risk premium creeping back into the market.
And there were two main ones. First, President Trump floated a 10% cap on credit card interest rates.
And a massive 25% tariff on countries trading with Iran.
The credit card cap is the one that really scared the financials, right?
Oh, absolutely. If you cap rates at 10%, you fundamentally break the business model for any subprime credit issuer. I mean, you're talking about wiping out billions in projected revenue overnight.
It's a binary risk you just can't model.
You can't. But the second headline seemed to rattle the big institutional investors even more. And that was the Department of Justice inquiry regarding Fed Chair Powell's testimony.
This one is more nuanced, but it's critical.
It is. Global capital flows into the U.S. We're talking trillions of dollars because of what we call institutional trust. Investors believe the Federal Reserve is independent. They trust that Powell sets rates based on data, not because someone in the White House screamed at him.
So when you see the DOJ potentially investigating the Fed chair,
it introduces a level of risk you usually associate with emerging markets. I don't want to sound dramatic, but if the market starts to believe the central bank is becoming a political tool,
the risk-free status of U.S. Treasuries gets questioned.
And that anxiety was the undertone this week. It's why the VIX, the Volatility Index, stayed elevated despite that really good inflation news.
Okay, let's hop across the Atlantic. Usually when we do these deep dives, Europe is kind of the sick man section. We're always talking about stagnation.
Right, that's the usual story.
But this week, was Europe actually the growth story?
It feels like Europe is waking up from a 3-year nap. The headline number is Germany. The German economy finally emerged from recession.
It grew 0.2% in the fourth quarter.
Right, and 0.2% doesn't sound like a party, I get it.
Not exactly, no.
But in context, it's massive. It's the first growth Germany has seen in 3 years. Psychologically, that matters a lot.
And what's interesting is how they grew, right? It wasn't the export machine.
No, not at all. It was household and government spending. The German consumer is finally opening their wallet.
And on the structural side, we saw the EU provisionally approve that historic trade deal with Mercosur, the South American bloc.
They've been negotiating that for a quarter of a century.
25 years, yeah.
And the timing isn't an accident. Europe is realizing it can't rely on the U.S. because of protectionism, and it can't rely on China with their slowdown. They need new markets. This deal eliminates tariffs on 90% of trade between them.
That's a huge potential tailwind for their exporters.
It is. It's Europe trying to become dynamic again.
Yeah.
And we saw that optimism spill over into the UK as well. FTSE 100 was up over 1%. UK GDP rose 0.3% in November, which beat forecasts.
I noticed a specific detail in that UK report about Jaguar Land Rover.
Yes, this was key. JLR had a really significant rebound in production.
And why does that matter so much?
Because the knock against the UK recovery has always been that it's just services, coffee shops, consultants, finance.
The industrial side has been weak.
Exactly. JLR rebounding shows that the industrial engine is actually turning over. And when you have both services and manufacturing firing, that's a durable recovery, not just a blip.
All right, let's move over to Asia. If you wanted to make money this week, you really needed to be in Japan. The Nikkei 225 just jumped, nearly 4%?
Almost 4%. Yeah, Japan was the star performer globally.
So what fueled that? Was it just the weak yen again, or was there something more fundamental happening?
It was heavily political. There's a lot of buzz about a snap election likely happening in early February under Prime Minister Sanae Takaichi.
And markets usually hate elections because of the uncertainty. Why do they seem to like this one?
Because the market believes Takaichi is going to secure a really strong mandate, and she's running on a platform of massive fiscal stimulus.
Ah, so investors are front-running the spending.
They're front-running the government checks, they're buying construction stocks, industrials, all the companies that will benefit.
But the currency was all over the place. The yen weakened, then it suddenly stabilized right around 158.
That was classic jawboning. The finance minister, Satsuki Katayama, she basically came out and just said, "We're watching and we have ammo."
Just a verbal intervention.
And that scared the speculators enough to stop shorting the yen, at least for a few days. But there is a catch.
With the Bank of Japan, there's always a catch.
Always. Because inflation is lingering in Japan, the market is starting to price in a rate hike sooner than anyone expected, maybe as early as April.
Wow.
And if rates go up in Japan while they're coming down to the U.S., that whole yen carry trade could unwind very, very fast.
Okay, let's touch on China before we look ahead. The macro data looked incredible. I mean, blockbuster trade numbers. But the stock market did not get the memo. CSI 300 was down.
It was a classic good economy, bad market week for China. The export numbers were just wild up, 6.6%. China's annual trade surplus topped $1.2 trillion.
1.2 trillion. That's an insane number. That is money flowing into the country. Why aren't stocks ripping higher on that?
Because the regulators stepped in. They raised margin requirements for stock purchases to 100%.
Okay, let's define that for anyone listening who isn't day trading.
So margin is essentially borrowing money from your broker to buy more stock than you have cash for. It amplifies your gains, but it also amplifies your risks.
And retail investors love it.
They do. So the Chinese government saw the recent rally, decided it was getting too speculative, and they just cut off the leverage.
And raising the requirement to 100% means?
It means cash only. No borrowing. You have to put up the full dollar amount for every share you buy. It immediately sucks liquidity out of the market.
And it sends a very clear signal.
A very clear signal that Beijing prioritizes stability over a bull market. They would much rather have boring flat markets than a bubble that bursts.
Wow. Okay, that's the world tour. Now let's look ahead. Next week is packed with data that could either validate or completely wreck these new trends.
It is absolutely going to be a volatile week.
Monday, January 19th. U.S. markets are closed for Martin Luther King Jr. Day, but the rest of the world is open.
And Monday is actually huge for China. We get their data dump, Q4 GDP, industrial production, retail sales.
And with the U.S. offline, liquidity will be thinner.
Much thinner. So if those China numbers surprise in either direction, the moves you see in Europe and Asia could be really exaggerated.
Okay, then we fast forward to Thursday, January 22nd. This is the big one for the U.S.
The PCE price index. For those who don't know, this is the Personal Consumption Expenditures Index. It's the Fed's preferred inflation gauge.
We already saw the CPI number. Why does PCE matter more?
Because the Fed sets policy based on PCE. If CPI is cool, but PCE comes in hot, the Fed will completely ignore the CPI. This is the number they care about.
Got it. And we also get the second estimate for Q3 GDP that day. Then Friday, January 23rd, we go back to Japan.
The Bank of Japan interest rate decision. And given those rumors about a potential April hike, every single word of that statement is going to be scrutinized.
And we also get flash PMIs from Europe and the UK on Friday.
Which is our trust but verify moment. We just spent time praising the German and UK recovery. The flash PMIs are real-time surveys if they dip back into contraction.
That whole European recovery narrative dies on the spot.
Instantly.
Okay, let's distill this down. We always like to give you the top 5 risks, the
Yep.
things that could blow up your portfolio next week if you're not paying attention. What's number 1?
Risk number 1 is a US PCE inflation surprise.
Walk us through the if then on that.
The market is currently pricing in a Goldilocks scenario. Inflation's dead, growth is fine. If that PCE number on Thursday comes in hot, it undoes that entire narrative. Bond yields will spike, and those small caps we just talked about,
They'll get crushed.
they will get crushed.
Okay, risk number 2.
China growth disappointment.
Because of that Monday data dump.
Yes. Markets are banking on China stabilizing the global supply chain. We saw that massive surplus. But if the internal engine, the retail sales number, misses the mark on Monday, it tells us China is still just a factory with no real internal demand.
And that hurts global companies like Nike or Starbucks.
Exactly. Anyone who needs the Chinese consumer.
Risk number 3.
BOJ policy shift speculation.
This is Friday's meeting in Japan.
Right. If the Bank of Japan even hints at tightening earlier than expected, it rocks the yen. A stronger yen is bad for Japanese exporters, so the Nikkei would tank. But, more importantly, it sucks liquidity out of U.S. and European markets as that carry trade unwinds.
Okay, risk number 4.
UK inflation stickiness.
We get UK CPI on Wednesday.
We do. If inflation stays stubbornly high in the UK, the Bank of England is forced to keep rates high. That kills that whole Jaguar Land Rover recovery story we just celebrated. It would prove the recovery was just a false dawn.
And finally, risk number 5.
Eurozone sentiment and the PMIs.
Specifically, the ZEW sentiment on Tuesday and then those flash PMIs on Friday.
Exactly. If these come in weak, the ECB might have to panic cut rates or change course. It would signal that the German Q4 growth was just a blip, not a real trend.
So, to summarize, we're looking at a world that is finding its footing, but it's incredibly uneven. Inflation is stabilizing in the U.S., allowing these real economy stocks to finally breathe.
Germany and the UK are showing signs of life.
But political noise in D.C. and Tokyo, plus the heavy hand of regulators in Beijing, keeps that risk premium high.
That's the summary. But here's the thought I want to leave you with. We talk a lot about the market, but this week really proved that the market is becoming a useless term.
Explain that.
Well, just look at the divergence. You have U.S. small caps hitting all-time highs while Chinese tech stocks are falling. You have European banks rallying while U.S. consumer banks are struggling. The correlation between all these asset classes is just breaking down.
So the old strategy of just buy the index and wait might be broken?
I think the idea that a rising tide lifts all boats is over for this cycle. The difference between the winners and the losers is getting wider and wider. The opportunity now isn't just about being long equities, it's about being in the right equities in the right region.
We're back to a stock picker's market.
We really are.
Divergence is the word of the year so far. Thank you so much for breaking all of this down. Listeners, keep a close eye on that PCE number on Thursday and don't let the headlines scare you out of the opportunities. Stay smart, stay ahead.
Still watching? Then you're one of us, someone who actually wants to understand the markets. If this helped you think sharper, tap like, share the insight, and hit subscribe. Smarter markets need smarter minds. Let's grow this together. New AI-powered episodes drop every week. Imagine this format: AI-powered, sharp, fast, built around your industry, your firm, your market. For investors, leaders, or teams that move fast, we create custom podcasts designed to inform and impress. Curious? Contact us to build yours. Bespoke, bold, built by Flamingo's Research and Advisory.